If you look at Dalal Street right now, RBL Bank looks like a patient in the prime of its life. It is a highly visible player in the private banking sector. You probably recognize their branding. They have a massive footprint in everyday retail operations, pushing out thousands of credit cards and aggressively expanding digital banking services to capture market share. Because of that outward expansion, the market has slapped a premium price tag on the stock. Right now, it's trading in the 320 to 340 rupee range. But we have to ask whether investors are paying for a genuinely healthy business or just a really good marketing facade. To find out, we need to see who is actually holding the bag. This chart maps out total company ownership. Notice this tiny sliver separating from the whole? That is the promoter holding, roughly 2.5% of their own bank. When the captains of the ship keep their own money off the deck, it changes the risk profile for every retail investor on board. Before you commit your capital, we have to run a rigorous financial autopsy. Let's start with the X-ray. We are going to strip away the market hype and look strictly at the raw mathematical value of the business. As we saw, the market currently prices a single share at 322 rupees and 45 paise. Look at this evaluation panel showing the gram number, calculating true intrinsic value. The scale tips because the mathematical value is only 231 rupees. It trades 39% above its worth, leaving no mathematical cushion to protect your capital. For a disciplined value investor looking for an economic moat, this math ends the conversation. You do not buy a business at a massive markup when it has no unique competitive advantage to protect its profits from rivals. Anyone buying at the current market price is paying a heavy premium for an illusion. You take on 100% of the downside risk with zero safety net. But perhaps the bank is growing fast enough to justify that premium. To check that, we have to cut deeper and examine the internal organs, the balance sheet. This mind map breaks down the bank's fundamental health. Right at the top, look at the return on equity. It sits at an abysmal 3.42%. For context, a healthy bank in this industry averages 12 to 15%. Return on equity measures efficiency. At under 4%, RBL struggles to turn capital into earnings. Down at risk factors, gross non-performing assets are creeping to 1.88%. Worse, 108,000 crore rupees are tied up in contingent liabilities. These metrics suggest a bank that is currently inefficient at turning capital into profit, while simultaneously allowing its off-balance sheet risks to build. It's a narrow path for any future growth to navigate, so the fundamentals are weak. Let's hook the patient up to the monitor and check the market pulse. How is the actual stock price behaving? The price action is collapsing. The stock has plunged below its 20-day, 50-day, and 200-day exponential moving averages. Every time the price crosses below one of these key trend lines, it triggers another bearish signal. The momentum indicators are flatlining right alongside it. Both the MACD and the stochastic oscillators recently triggered bearish crossovers, confirming the downward momentum is picking up speed. This Step 4 panel maps out the immediate battleground. Look at the heavy red resistance line marked at 327 rupees. The stock is trapped underneath it. Every time the price tries to rally, sellers step in and crush the breakout. Both the underlying math on the balance sheet and the market's current momentum are in complete alignment. The stock is sick. That brings us to the final diagnosis. When you combine a 22 out of 60 fundamental score, a solid grade D, with heavy bearish momentum, you get a very clear answer. For long-term investors looking for a secure place to park their capital, this is a value trap. It is too expensive, the risks are too high, and it needs to be completely avoided right now. There is only one exception. If you are a short-term swing trader who knows how to manage risk, you might play the volatility. You'd look for an entry around the 315 mark on a pullback with an incredibly tight stop loss set at 308. But that is a short-term trade, not a long-term investment. If you truly want to own this bank long-term, you have to wait for the patient to actually recover. Your homework is to watch the upcoming Q4 results. Don't touch the stock until gross NPAs drop below 1.5% and the return on equity finally climbs back above 8%. Until those numbers hit, RBL Bank belongs in the financial ICU. Put it on a watch list to monitor its vitals, but keep it completely out of your active portfolio until it proves it has restarted its heartbeat.